You might think the biggest winners in the AI era have to be GPU companies, but Microsoft's latest earnings are quietly pointing to a very different answer. As AI moves from spending to actual orders, and from concepts to real usage at scale, the real question becomes, who controls the next phase of AI infrastructure? Hey everyone, welcome to Deep Dive Stock Earnings. Today's video is focused on just one company, Microsoft. Let me put one thing up front. This earnings report isn't about vision or storytelling. It's already showing tangible results from AI at scale. If you're only looking for short-term trades, this video may not be for you. But if you care about whether AI is truly entering a sustainable monetization phase, you want to stay with me. Let's start with the fundamentals. In the latest quarter, Microsoft reported total revenue of about $77.07 billion, up 18% year over year, or roughly 17% excluding currency effects. Operating income grew around 24%, and earnings per share came in at $4.13, up more than 20%. More importantly, this growth happened while the company continued to ramp spending on AI compute, data centers, and R&D. That tells us these investments are not hurting profitability. Effect. Operating leverage is starting to show. This is a critical point when a company of Microsoft's size can significantly increase capital and R&D spending while maintaining strong margins. It usually means demand is real and absorbing those investments. In other words, this isn't growth driven by cost cutting. It's growth driven by real usage, turning investment into sustainable returns. That's why the market is beginning to reassess Microsoft. Looking at the business mix, Microsoft Cloud revenue reached about $49.01 billion for the quarter, up 26%. More importantly, commercial remaining performance obligations report jumped more than 50% year over year to nearly $400 billion, with an average duration of around 2 years. That means these aren't distant assumptions. These are real budgets customers have already committed and are actively consuming. Order size is growing, but the pace of delivery hasn't slowed. RPO often tells you more than quarterly revenue. It represents long-term budget commitments already signed, not optimistic guidance. When RPO continues to accelerate at this scale, it shows customers aren't just testing either deploying. It is long-term infrastructure. That's a key signal for any medium-term judgment. Within the business, Azure remains Microsoft's core growth engine. This quarter, Azure and related cloud services grew close to 40% year over year. Management repeatedly emphasized that the main constraint right now isn't demand, but the pace of bringing new compute and data center capacity online. In other words, real demand is still running ahead of supply, which explains why Microsoft continues to expand capital spending and accelerate infrastructure build-out. Many investors worry that Microsoft's capital spending is too aggressive, but when you break it down, a significant portion of the spending goes into shorter life assets like BIOS and CPUs that closely match contract durations. This approach essentially uses controlled depreciation to match already locked-in demand, rather than blindly building capacity for an uncertain future. At the application layer, Microsoft 365 Copilot usage continues to deepen. Enterprise customers are moving from small pilots to broader deployments across productivity, development, security, and healthcare. AI is being embedded directly into daily workflows. The depth of usage is what turns AI from a feature upgrade into stable, recurring subscription and services revenue. When you put Cloud, RPO, Azure, and Copilot together, it becomes clear that Microsoft's AI strategy doesn't rely on a single breakout product. It's driven by platform-level diffusion. That structure may not create extreme spikes, but it delivers far greater stability and resilience across different macro and industry cycles. Looking at the stock price, Microsoft hasn't shown the typical emotion-driven earnings spike before and after earnings. The stock has mostly been consolidating at higher levels, rather than surging or selling off sharply. This kind of price behavior usually means the market isn't rejecting the fundamentals. It's taking time to digest and gradually confirm the AI-driven growth narrative. When you put everything together, Microsoft isn't going through an emotion-driven re-rating. It's going through a rate pricing based on real orders, real usage, and real cash flow. Short-term volatility will always exist, but what truly determines long-term value is whether AI continues to translate into durable returns. Do you see Microsoft as a mature tech stock or as a core AI infrastructure play? Let me know in the comments. This is Deep Dive Stock Earnings. See you next time.